Hello dear friends, I am Ram, I am a CFA charter holder. So today in this video we are going to discuss about types of mutual funds and its suitability for the investors. So there are broadly three types of mutual funds are there. One is equity mutual funds, debt mutual funds and the hybrid mutual funds or the balanced funds. First let us discuss about equity mutual funds. There are mainly three types of mutual funds are there within the equity and there are other mutual funds. Let us discuss about those three first. There are large cap mutual funds, mid cap mutual funds and small cap mutual funds. Recently SEBI categorized these funds very clearly and defined them very clearly. So let us look at those definitions specifically. So large cap mutual funds means 80% of its assets should invest in the top 100 companies. Okay, and mid cap mutual funds means 65% of its assets should invest in the companies which are from top 101 to 250 companies. So in those 150 companies, SEBI called them as mid cap companies. So beyond 250 companies, SEBI called them as small cap companies. So small cap mutual funds invest 65% of its assets in those companies. So remaining 35% in mid and small and 20% in large cap companies, large cap mutual funds, they can actually invest in other caps. Like 35% of the mid cap companies can be invested in large and small cap companies, like that. Come to risk return issues and the suitability of these funds. As large cap funds invest in large cap companies which are more matured companies and the big companies in India. So these are usually less risky compared to the mid and small cap companies. So when it comes to returns, you can expect broad market index returns like Nifty and Sensex returns in large cap mutual funds. Whereas mid and small cap mutual funds are a bit more riskier than large cap companies, but at the same time, come to returns, you can expect bit more returns in mid and small cap companies compared to large cap companies. Next type of mutual fund is multi-cap fund. As name suggests, this multi-cap fund can invest all types of market cap like large cap funds, mid cap funds and small cap funds. So these funds invest across the market caps. So also these multi-cap funds are having a unique benefit that when market come into a correction zone, these funds tend to move its funds to large cap companies to avoid steep losses. At the same time, when market tend to move to upward direction, these multi-cap funds move its funds to mid and small cap funds, mid and small cap companies, so that they can get good alpha. So it is suitable for all kinds of investors, especially especially multi-cap funds are suitable for new investors, those who don't know anything about investing in mutual funds, so they can actually start with these funds. And next category is dividend yield funds. Dividend yield funds usually invest in dividend paying companies, right? Mostly dividend paying companies are large and matured companies, so that from risk point of view, you can expect a lower risk in these funds. Returns also you can expect the stable returns. These funds mostly suitable for the investors who are expecting monthly revenue. Come to next category, focused funds. Focused funds are those they can invest only up to 30 companies as per the SEBI guidelines. So downside in these funds is when any company in this fund affected by negative issues or company specific issues, so these funds can also get affected badly because portion which is allocated to every company would be very high because in the nature of focused. Next category is value and contra funds. These funds invest based on value strategy. It means they try to find out low PE, low P by book value matrix in the companies in which they invest. Okay, so based on many researches, so value companies usually tend to outperform the growth companies over a long period of time. But unfortunately in India we have very less value funds, and those funds also not actually not 100% following the value strategy, right? And come to next category, ELSS funds. So these funds gives us a tax benefit. Those who need tax savings under section 80C, they can actually invest in these funds. These funds also from risk point of view, these are also low risk funds. You can expect around 18 to 16% return in these funds. When you add up tax benefit to the returns of these funds, you can actually get very good return. And come to other category in equity funds, sector and thematic funds. Sector funds like we have pharma fund, IT fund, and thematic funds like consumption based theme. So one should be careful while investing in these funds, because sectors may not perform every year in the same way. For example, infrastructure sector is a cyclical sector. It may not perform each year in the same fashion. So one should have the knowledge about this sector while investing in these sectors. Otherwise, you should better to avoid these funds. So these are the equity funds. Now let us discuss debt funds. So there are different debt funds which are differentiated by the duration of its investments. So let us read the SEBI guidelines of these funds. So first fund is liquid fund. Liquid fund invests in debt and money market securities with the maturity of 91 days. And come to second fund, ultra short duration fund, which invests in the debt bonds having maturity of 3 to 6 months. And low duration fund, which invests 6 to 12 months bonds. Money market fund, which invests maturity having up to 1 year. So short duration funds which invest maturity having 1 to 3 years. Medium duration fund which invest duration having 3 to 4 years. Medium to long term duration fund which invest 4 to 7 years maturity bonds. And long duration fund which invest more than 7 years bond durations. So these are all and other fund is dynamic bond which invest across the durations. So these are all funds differentiated by the investment duration which are investing in those bonds, right? Come to safety point of view, liquid funds are the more safer funds compared to other debt funds, because these funds invest only 91 days bonds, right? I just wanted to discuss one important point here. Those who are investing in debt funds should understand the interest rate dynamics and the duration dynamics, because these affects bond returns, right? When interest rates increases steeply, long-term duration funds may perform very badly, because principal component may affect badly, even though interest component perform well. Different duration bonds affect differently when interest rate changes to downward or upward. So you should understand those dynamics. Unless you don't understand those dynamics, you better to stick to liquid funds only. There are other two funds in debt funds. They are corporate bonds and gilt funds. Corporate bond funds, they should invest at least 80% of its assets in the corporate bonds. In the same way, gilt funds should invest 80% of its assets in the government bonds. That's it about debt funds. Now let us move to third category, which is hybrid schemes. So first mutual fund type in hybrid schemes are conservative hybrid fund. So it should invest 10 to 25% in equity and 75 to 90% of its assets in debt. Okay, balanced hybrid fund is the next category in it. It invests 40 to 60% in the equity and 40 to 60% again in the debt. And third type in hybrid schemes, aggressive hybrid fund, which invests 65 to 80% in equity and 20 to 35% of its assets in debt. So dynamic asset allocation or balanced advantage fund, it invests in equity and debt dynamically based on the market conditions. Other fund type is multi-asset allocation. Invest in at least 3 asset classes with the minimum allocation, which means it can invest in equity, it can invest in debt, and it can invest in commodities also. So, but at least 10% allocation should be given to each asset class. So, other fund type is arbitrage fund. It follows the arbitrage strategy to invest. For example, for a particular company share is trading 100 rupees and its future is trading 105. So it try to grab that difference as a profit. Come to risk return and suitability issues of hybrid funds. Those who don't want 100% equity allocation, they can invest in these so that they can reduce the risk, as these funds have the debt component in it. At the same time, they can expose to equity exposure also, so that they may get returns in between debt funds and equity funds. At the same time, risk also far lower than equity funds, bit more than debt funds. There is one other category of funds which are not covered in these broad categories of equity, debt and hybrid funds, which are index funds and the ETFs. So these index and ETF funds broadly track the indexes like Nifty 50, BSE, Sensex. So that's it, friends, about types of mutual funds and its suitability. Hope you like it. Please subscribe to my YouTube channel FinShoppy if you haven't done, and click the bell button. So thank you so much.